Good morning, and welcome to the Deere & Company second quarter earnings conference call. Your lines have been placed on listen only until the question and answer session of today's conference. I would now like to turn the call over to Mr. Josh Jepsen, Director of Investor Relations. Thank you. You may begin.
Thank you. Hello, good morning. Also on the call today are John May, Chairman and CEO, Ryan Campbell, Chief Financial Officer, Corey Reed, Ag and Turf Division President, and Brent Norwood, Manager of Investor Communications. Today we'll take a closer look at Deere's second quarter earnings, then spend some time talking about our markets and our current outlook for fiscal 2020. After that, we'll respond to your questions. Please note, slides are available to complement the call this morning. They can be accessed on our website at johndeere.com/earnings. First, a reminder, this call is being broadcast live on the internet and recorded for future transmission and use by Deere & Company. Any other use, recording, transmission of any portion of this copyrighted broadcast without the express written consent of Deere is strictly prohibited. Participants in the call, including the Q&A session, agree that their likeness and remarks in all media may be stored and used as part of the earnings call. This call includes forward-looking comments concerning the company's plans and projections for the future that are subject to important risks and uncertainties. Additional information concerning factors that could cause actual results to differ materially is contained in the company's most recent Form 8-K and periodic reports filed with the Securities and Exchange Commission. This call may also include financial measures that are not in conformance with the accounting principles generally accepted in the United States of America, or GAAP. Additional information concerning these measures, including reconciliations to comparable GAAP measures, is included in the release and posted on our website at johndeere.com/earnings under quarterly earnings and events. I'll now turn the call over to John May.
Thanks, Josh. Good morning and welcome to John Deere's second quarter earnings call. Before discussing the details of the quarter, I'd like to begin the call with an overview of our response to COVID-19 and the near-term implications of the pandemic for our business. First off, I sincerely hope that you and your families are safe and healthy and well. These times are challenging for many people, and my thoughts are with those affected by COVID-19. Additionally, I'd like to express my sincere gratitude to those who are serving our communities so that we can all overcome this pandemic. From the courageous medical professionals to those tirelessly working in industries essential to stability and recovery, such as the extraordinary colleagues at John Deere and many of our customers, I want to say thank you. As John Deere has responded to COVID-19, our first priority has been and will always be the health, safety, and overall welfare of our employees. It is only by protecting our workforce that we can ultimately deliver on our commitment to our customers and fulfill our role as an essential business, a designation we are both proud of and humbled by. Over the last 2 months, we've proactively implemented additional health and safety measures at our operations around the world. Importantly, many of these measures were taken on very early and ahead of regulations or official guidelines. These measures, such as employee health screening, additional personal protective equipment, social distancing guidelines, enhanced cleaning and sanitation efforts, and staggered production schedules. By diligently pursuing health and safety measures, we not only help protect our workforce, but we also provide our employees with peace of mind so that they feel secure coming to work. And consistent with our dedication to health and safety in our workforce, we also provided a number of additional benefits to encourage employees to take care of themselves and their loved ones without fear of financial harm. These additional benefits help support symptomatic employees or those deemed high risk, while also supporting workers who are challenged by the lack of school or daycare options. During this time, our strong partnership with the UAW and other labor organizations across the globe has played a key role in helping us implement these measures, allowing us to answer the call as an essential business. Report that substantially all of our global manufacturing, with exception of a few facilities operating at limited capacity, such as those in India. Our commitment to health, safety, and well-being extends outside of our walls and into the communities our employees call home. For instance, John Deere is producing thousands of protective face shields to meet the immediate and ongoing needs of healthcare workers serving our communities. To this, we add our foundation support of our social safety net in our home communities around the world, highlighted by our recent investments in food banks and their capacity. At the same time, we're also modifying our work to ensure can keep their operations running. Underlying Deere's designation by many governments as an essential business is the fundamental recognition of the role our customers play in securing our global food supply and vital infrastructure. One goal has been to maintain customer uptime. To do this, we've kept new equipment shipments moving and parts depots operational around the world. Tasks, particularly the complexities of the regulatory, economic, and other barriers that have affected our supply chain. As it relates to our dealer channel, the vast majority are operating today, and we're able to maintain business safely throughout the last 2 months. Importantly, they've leveraged our e-commerce tools and connected support capabilities throughout the pandemic, allowing them to remotely service customers, machines, and maintain appropriate social distancing. Ultimately, the measure that we've taken to ensure continuity of operations have enabled our customers to carry out the essential work of promoting food security and providing critical infrastructure. While customers' operations vary around the world, this is an especially critical time for those involved in agriculture. During the last 2 months, many of our customers have been planting or harvesting a crop, and therefore have required continual support from John Deere and our dealers. Furthermore, John Deere Financial has continued providing financing to customers globally throughout this crisis and has provided flexible terms to customers experiencing disruptions due to COVID-19. To best summarize our efforts over the last 2 months, we are protecting our employees, who in turn help ensure that the essential operations of our customers keep running. And where our customers need even further support and financial assistance, John Deere Financial allows us to serve customers in ways that others cannot. In addition to the operational actions, we've also proactively managed our balance sheet and cost structure to ensure we are well capitalized through this period of uncertainty. Over the years, we've built a business with a cost structure that can flex with movements up and down the cycle. So much of this is already in our DNA. In addition to that, we plan to make further structural improvements beyond the typical cost levers we pull throughout the cycle. Lastly, I'd like to revisit the strategy we laid out during our analyst event at CES in January. Regardless of COVID-19, all of the key elements of our strategy continue to direct our efforts. We continue to work on executing our priorities, which have proved more important now than ever. First, we are focusing on capital allocation, both investments in R&D and investments to the areas of greatest potential for differentiation and profitability, resulting in intensified precision ag investments, higher penetration in our aftermarket and retrofit business, and an increased emphasis on high-performing product lines while actively addressing any lower-performing product line. Second, we are reorienting our organization design to create a business that is more customer-focused across the entire production system in order to better capitalize on the immense opportunity in front of us. As it relates to intensifying our precision ag business, the current environment of Deere's technology stack as a key differentiator. We've been investing in machine connectivity and data platforms for nearly a decade. Having those foundational has enabled our connected machines metric to increase significantly year over year, which has provided, in some cases, triple-digit growth in adoption of the services like remote display access, service advisor remote, and expert alerts. In light of the current circumstances, we see it as an obligation to continue investing in precision technologies that support customers and keep them running. We remain convinced of the value of creating a more agile organization to more nimbly respond to ever-changing market conditions. These organizational shifts will ensure our managers are empowered to make decisions and take action as required. At this time, I'd like to turn the call over to Brent Norwood to cover some of the details on the quarter. Brent?
Thanks, John. Now, let's take a closer look at our second quarter results beginning on slide 5. Enterprise net sales and revenues were down $9.25 billion, while net sales for our equipment operations were down 20% to $8.22 billion. Net income attributable to Deere & Company was down 41% to $665.8 million, or $2.11 per diluted share. In the quarter, the company recorded impairments totaling $114 million, $5 million after tax related to certain fixed assets, operating lease equipment, and a minority investment in a construction equipment company headquartered. At this time, I'd like to welcome to the call Cory Reed, President of Ag and Turf for the Americas, for a discussion of the division's results. Cory?
Thanks, Brent. Second quarter results on slide 6. Net sales were down 18% compared to last year, and the impact of currency translation partially offset by positive price realization. Price realization in the quarter was positive by 1.5%, while currency translation was negative by 2%. Operating profit was $794 million, resulting in a 13.3% operating margin for the division. The year-over-year decrease is primarily due to lower shipment volumes, sales mix, along with the unfavorable effects of foreign currency exchange. These factors were partially offset by price realization, lower selling, administrative, and general expenses, reduced production costs, and lower research and development expenses. Before reviewing our industry outlook, I'll first provide an update on the operational status of our facilities around the world, as well as some commentary on the regional dynamics impacting ag markets, starting on slide 7. In North America, nearly all ag and turf facilities have remained operational during the second quarter. A few factories have experienced temporary production stoppages due to the supply-based disruptions. Although risk and uncertainty remain, we currently forecast to recover any delayed shipments throughout the balance of the year. For our large ag business, the remainder of our 2020 production schedule is largely backed by customer orders through either our early order programs or rolling order books. Specifically, order programs are completed, while large tractor order books extend into the fourth quarter. Right now, our North American customers are focused on planting and crop protection. Planted acres for soybeans are expected to rebound this year, while corn acres are forecast in 2012. Favorable spring weather has resulted in above-average planting progress at this stage of the season and is running well ahead of last year's severely impacted progress. Despite the recovery in planted acres, the current environment is weighing on farmer sentiment as near-term demand for agricultural commodities remains uncertain. Recently, combined with decreases in ethanol demand of elevated carryout levels for grain prices. The impact of the Phase 1 agreement with China remains, since most agricultural exports to China from North America tend to occur around the harvest season. See approach on any anticipation of an uptick in exports. And variables, large row crop farmers, by and large, have continued operations as normal. And on a positive note, key input costs, such as fuel, providing some offset to the decline in commodity prices. Dairy and livestock farmers, on the other hand, have seen greater degrees of short-term disruption due to lower milk and protein prices. Restaurant and school closures have shifted food supply of some egg products in the near term. Government aid directed towards these producers will help offset this segment to remain challenged for the year. Regarding our consumer-oriented businesses in the U.S., turf and utility sales have remained resilient, especially in the season, with many U.S. consumers quarantining, and together with favorable spring weather, lawn projects have buoyed demand for products such as riding lawnmowers. And while we've been encouraged by demand, that demand is typically driven in part by the overall economic situation. And as a result, we've taken a more cautious outlook for the rest of the year. Farming conditions in Brazil have been favorable as the first crop is mostly harvested and expected to set a record for soybean production, despite some persistent dryness in the southern growing region. Also in overall good condition. Crop exports have been partitioned in the Brazilian real as post. Despite the solid levels of profitability, farmers have remained cautious on further investment due to the uncertainty caused by COVID-19, as well as possible implications stemming from the Phase 1 U.S.-China trade agreement. Facilities are largely operational after experiencing some short-term disruptions. This is due in large part to the amazing efforts of our place to both keep employees safe. As an example, at one facility, we entirely restructured our processes over the course of 2 days and were able to reopen immediately thereafter. 2 shifts, enhanced social distancing by workstation, and procured additional personal protective equipment. Furthermore, we designed and trained employees on entirely new work protocols, employees the confidence to return to work. Within a week of establishing these new processes, our facility was operating near its original level of productivity. This is just one of many examples in the region where we've taken extraordinary efforts to maintain operations in order to support our customers. While our facilities remain up and running, market conditions in Europe are mixed. Arable farmers are contending with the uncertainty of lower yields due to adverse weather and affected by the pandemic. Despite the uncertainty, conditions for arable farmers remain mostly stable to the incomes. On the other hand, the dairy sector has been negatively impacted by the closure of schools and restaurants and the overall disruption to the food supply chain and near-term changes in consumption. Pork margins remain strong as exports to China are at an all-time. In Asian markets, our operations have varied significantly by country, all open after experiencing closures in January and February. Meanwhile, late March through most of April in our operations. Correspondingly, market conditions and sentiment vary country by country, with key markets in India, China, and Southeast Asia moderating. Before reviewing our industry outlook, I'd like to highlight a few themes observed that reflect the value of our dealer channel. First, regarding our channel. It's important to note that substantial operational during the quarter service our customers. we've long viewed their overall financial health in our industry. Financially, our North American ag channel came out of the last agricultural trough today as they work through COVID-related challenges from a position of strength and stands ready to serve an industry fleet advancing in age, while offering support on new technologies that deliver overall better outcomes. Because of consistent investments made by both the last 10 years, we're uniquely able to serve our customers in this challenging environment in a way that sets us apart from other industry players. The combination of dealer coupled with Deere's investment in critical precision ag infrastructure throughout the pandemic equipped large ag vehicles with connectivity. This basic connectivity was the first critical step in precision tools customers rely on today. Features like the John Deere Operations Center, Service Advisor Remote, Expert Alerts, and Remote Display Access are all part of a comprehensive precision ag infrastructure decade and important tools that feed our data and analytics capabilities. Our dealer channel already has the resources and infrastructure in place to actively utilize these tools and to serve our customers. Over the years, they've invested significantly in establishing their own technology departments and operations centers to better monitor and service customer machines. For example, over the last 2 years, our Brazilian channel established over 30 customer data operation centers dedicated to the full-time monitoring and support of customers' operations. The value of these collective investments became more evident than ever over the course of the last few months. We've seen a significant increase in the use of our connected support tools, with total connected machines here, totaling over 200,000 ag machines worldwide. For some features, such as remote display access, we've seen adoption since last year. The increase has been particularly encouraging in regions like Europe and Brazil. Not only have these tools allowed customers to practice social distancing guidelines, they've also decreased downtime and the cost of their operations. So while the recent environment has been challenging on many fronts, it's also confirmed to us that our strategy to intensify our precision investments while reshaping our organization to allow for greater degrees of agility and responsiveness is positioning us to deliver our customers a truly differentiated experience. With that context, let's turn to our 2020 Ag and Turf Industry Outlook on slide 9. We expect ag industry sales in the U.S. and Canada to be down roughly 10% for 2020. In slightly more challenging conditions in Canada. Moving on to Europe, the industry outlook is forecasted to be down 5 to 10% as a result of lower yields for arable farmers and a difficult market for dairy producers. In South, and combines are projected to be down 10 to 15% for the year. Despite relatively positive fundamentals in Brazil, farmers have adopted a cautious stance due to COVID-related uncertainty and any potential shifts in global trade between the U.S. and China. Meanwhile, there remains an ongoing economic uncertainty in Argentina. Shifting to Asia, industry sales are expected to be down moderately as key growth markets like India slow due to countrywide lockdowns. Lastly, industry retail sales of turf and utility equipment in the 10% in 2020. Despite positive sales trends through the second quarter, we've taken a more cautious outlook on the rest of the year. Moving on to our Ag and Turf forecast on slide 10. Fiscal year 2020 sales of worldwide ag and turf equipment are forecast to be down between 10 and 15%, which includes expectations of 2 points of positive price realization, offset by currency headwind of about 2 points. For the division's operating margin, our full year forecast is ranging between 8.5 and 10%. At this time, I'd like to turn the call back over to Brent Norwood to cover details on the quarter for Construction and Forestry Division. Brent?
Now, let's focus on Construction and Forestry on slide 11. For the quarter, net sales of $2.26 billion were down 25%, primarily due to lower shipment volumes and the impact of currency translation, partially offset by positive price realization. Operating profit moved lower year-over-year to $96 million, primarily due to lower shipment volumes and sales mix, impairments of an asphalt plant in Germany, and an unconsolidated equipment company headquartered in South Africa, and the unfavorable effects of foreign currency exchange, partially offset by lower production costs and price realization. Let's turn to our 2020 Construction and Forestry Industry Outlook on slide 12. Construction equipment industry sales in the U.S. and Canada are now forecast to be down between 20 and 30%, reflecting sharp declines in oil and gas activity, rental capex, as well as overall moderation in general economic activity during the second quarter. To global forestry, we now expect the industry to decline 15 to 20% this year, with the U.S. and Canada markets declining more than the rest of the world as lumber and pulp prices soften in North America. Moving to the Cnf Division Outlook on slide 13. Deere's Construction and Forestry 2020 net sales are forecast to be down between 30 and 40% compared to last year. To the industry guidance reflects plans to take further actions to reduce field inventory. The order book remains within our historical 30 to 60-day replenishment window, but at a much reduced production schedule. Our net sales guidance for the year includes expectations of about 1 point of positive price realization and a currency headwind of about 2 points. For the division's operating margin, our full-year forecast is ranging between 2 and 4%. Let's move now to our financial services operations on slide 14. Attributable to Deere & Company in the second quarter was $60 million as a result of a higher provision for credit losses, unfavorable financing spreads, and increased losses and impairments on lease residual values, primarily for construction equipment, partially offset by income earned on a higher average portfolio. 2020 net income forecast is now $490 million, which contemplates a tax rate of 26%. The provision for credit losses in 2020 is forecast at 37 basis points, reflecting a higher degree of uncertainty relative to last year. Slide 15 outlines our guidance for net income, our effective tax rate, and operating cash flow. Our full-year outlook for net income is now forecast to be in $2 billion, with an effective tax rate projected to be between 22 and 24%. Cash flow from the equipment operations forecast is now in $0.3 billion for 2020. I will now turn the call over to Ryan Campbell for closing comments.
To respond to your questions, I'd first like to offer some thoughts on our liquidity position, cost management, financial forecast at CES. Some of the actions taken during March and April financial position. In mid-March, we stopped our share repurchases. In late March and early April, we successfully executed 2 medium-term raised $2.25 billion U.S. dollars through the issuance of 5, 10, and 30-year notes, through the issuance of 4, 8, and 12-year notes. Also in March, we successfully renewed our revolving credit facilities totaling $8 billion, an increase of $200 million from our prior year renewal. These actions provide extra support for our overall liquidity profile in light of the continuing uncertainties arising from the ongoing COVID-19 pandemic. They are also squarely in line with our use of as well through these challenging times. These are to maintain our A rating, fully fund our operations, pay dividends to shareholders, and finally, as it relates to cost management, reflect our strong heritage of managing performance throughout the business cycle. In turn, we were able to maintain decremental margins below 25%, even including the cost program in our first and second quarters and the impairment charges taken. The quick actions taken by employees at all levels, pulling cost and capital levers, allowed us to achieve a challenging environment. Second, I want to provide some perspective on the $1.6 billion to $2 billion net income forecast. It goes without saying, but I want to emphasize that we are still operating in a very uncertain environment given the ongoing COVID-19 pandemic. However, some perspective on our current estimate of fiscal 2020 financial performance. Our forecast is driven by estimated industry performance as well as our expected. All parts of our business have some level of demand uncertainty. Certain early order programs operate on more of a sold ahead basis, and we have higher visibility to demand and have lower levels of visibility as they do not operate off early order programs and tend to be driven to a larger extent by general economic trends such as housing starts, the price of oil, levels of GDP, and other factors. Our ranges attempt to reflect these dynamics. In addition, supply-related risks remain as our global supply base deals with the complexity caused by the COVID-19 pandemic. Capabilities, they contend with uncertainties caused by the pandemic, such as workforce availability, effectiveness, and availability of transport carriers, and pricing of materials. Uncertainty also remains with respect to our ability to maintain the level of operation required to support the production. Although we have had good success to date, there are many different factors that can impact our production and other operations. First and foremost, the environment for our employees. Our forecast attempts to reflect these estimate based on the factors that drive our performance as we see them as of today. The higher end of the range reflects our current expectation of the current environment with minimal disruption, while the lower end of the range would reflect lower order receipts coupled with higher levels of manufacturing suspension. Given the complexity and uncertainty of the COVID-19 pandemic, actual performance could deviate from our range. Finally, I want to emphasize John's points. CES seems like a long time ago, given everything that has happened over the last few months. However, managing through these difficult times leaves us even more convinced in the priorities we articulated at that time, to the areas that have the highest potential for differentiation, like large and production system ag. Accordingly, as we have pulled levers to reduce costs in this environment, we have protected the investment in these areas, as they will be a significant driver. We will aggressively drive growth in our aftermarket parts and retrofit business, and we will drive more efficiency in our cost structure in order to move with enhanced speed and agility, unlocking the full potential of our talented employee base.
To begin the Q&A portion of the call, the operator will instruct you on the polling procedure. In consideration of others, please limit yourself to one question. If you have additional questions, operator?
Thank you. If you would like to ask a question, please press star one. You will be prompted to record your first and your last name. Please unmute your phone when recording your name, and to withdraw your question, press star two. One moment, please, for the first question. Our first question comes from Jamie Cook with Credit Suisse. Your line is open.
Hi, good morning, and glad to hear everyone's well. I guess just my first question, can you just address, you talked additional or looking at structural costs. Can you talk about sort of the items that you're contemplating and what that could potentially mean, if any, for savings in 2021? And then just to follow up on that, are there any costs associated with the structuring implied in your net income guide? Thank you.
Hey, thanks, Jamie. I'll start. As we think about cost actions that we've taken that we executed in the first quarter, we're seeing savings on that throughout the remainder of 2020. On top of that, as we've talked about, we pulled levers. We reduced SA&G. The full year, we expect it to be down about 11%. We've been more targeted or surgical, and then we also see some things, bit of an automatic lever, as we shift. Those are the things that would be contemplated in our guide as it relates to anything in this forecast today.
Jamie, it's Ryan. I'd point you back to CES and our talking points there. We're still executing against that strategy, and we said about 1 point of structural cost improvement or structural improvement in our margins will come from cost. So we've got the voluntary separation programs we did in 19 and 20. The full year run rate on those is about 120 million. We talked about the Wirtgen synergies of about 125 million euro. That would leave us about 100 million plus remaining of actions related to cost efficiencies, looking at footprint, looking at organizational design. We'll make those decisions over the next several months, and we'll update as those decisions get made.
Thank you.
Thank you.
We'll go ahead and jump to our next question.
Our next question comes from Jerry Revich with Goldman Sachs. Your line is open.
Yes, hi. Good morning, everyone.
Hey, Jerry.
I'm wondering if you can talk about precision ag. So we're hearing from the field that adoption rates have actually been ahead of expectations for a lot of folks on RTK and precision planting. Can you talk about what your take rates for those products are looking like for this season? And if you could update us on the aftermarket Exact Emerge kits.
Yeah, I'll start, Jerry. I think, when we look at precision ag, I think we're continuing to see, strong adoption. Corey made reference to, our connected machines, over 1,000 connected machines, engaged acres now, over 190 million engaged acres. Those are the things that are driving, the underlying tools that are executing on that. That's, we continue to see strong adoption of things like Exact Emerge and plants. This year, obviously, weather's been conducive, but you're seeing significant improvements in what we've done there. And, things like Combine Advisor, some of the things that we've talked about in the past all continue to be strong. I think today we can add some context here, just what we're seeing on the aftermarket side. Deliver a customer experience to customers that is somewhat unmatched. This.
Yeah, Jerry, I would start with, we made a couple of comments about the core infrastructure. The ability to connect out to each of these machines at the system level has allowed us to keep customers up and running. An example of planting, we had a customer who had hooked his planter up wrong. We're now getting digital connections between those planters back to our dealers, those machines down to the individual row unit without having to be in the field looking at the problem. We're able to proactively see that alert come through, alert the customer when they're doing appropriately, and be able to turn that into a fix that allows that customer's crop. That's one of 1,000 of these examples. On the aftermarket side, it's been incredible to see how the digital infrastructure has allowed us to see machine failures, be able to connect with customers through digital portals, new aftermarket connections back to the dealership in a way that allows face-to-face transactions. So a decade of putting the infrastructure in place that's allowed our customers and dealers to now take that infrastructure and turn it into a tremendous experience for them in a difficult.
All right. Thanks, Jerry. We'll go ahead and go to our next question. Appreciate it.
Ashish Gupta with Stephens, your line is open.
Hi, good morning. Thanks for taking the question. Just following up on, aftermarket. Have you guys, sort of pick up in aftermarket sales in the quarter, beyond what you would have expected, just being driven by the connected machines? And, based on what you're seeing so far, relative to the goals you have for, the long-term guidance, increasing aftermarket, are you kind of seems like you're getting an increased level of confidence in your ability to sort of achieve that aftermarket target?
Yeah, I think we're certainly early days on some of these initiatives, but I think we've seen good progress. I mean, the digital tools and being able to diagnose these things and do it proactively has definitely helped. This year we're planting earlier than we did last year, so that plays some role into it. But we have seen an uptick, particularly in North American ag parts, in the early part of the year. So that's been positive. Done a lot of work in addition to our parts organization to support that.
Yeah, a couple of things going on. Number one, we have an aging fleet. We've been down in new volumes over a number of years, so as the fleet age potential, if you look back, of the highest machine populations we put in. That aftermarket opportunity is huge. We've put an infrastructure in place to keep our customers up, our dealers that allow them to transact in an e-commerce way that differentiates them in the market. So a couple of points there. Obviously, there's an opportunity for us to both upgrades, things that we can take back across their fleet, and also over time. That aging fleet gives benefits in a number of ways. The connections that our dealers have been able to make using customer portals is a differentiator for them today, and they've continued to.
Yeah, maybe one last thing to add on top of that, just from our dealers have done a lot of work with, online showrooms, virtual, machine walk-arounds, and significant opportunities there of our dealers. And maybe in particular in Brazil, where we've seen just a lot of great activity relative to, how do we support and sell in a different environment. With that, we'll go ahead and go to our next question. Thanks, Ashish.
Thanks.
Our next question comes from Courtney Yakavonis.
Hi, thanks for the question. I appreciate the call you guys gave on some of the structural costs that you're addressing, but I think last quarter some costs, whether it was elevated freight or maybe some costs might be weighing on. Just kind of break out for us if there's anything that we should be expecting kind of as you guys are returning back to normal volumes that will weigh on margins.
Yeah, I mean, we've got included in our forecast, last quarter we talked about premium freight being one of the biggest items. So, we continue to expect that full year. On the ag side, for example, we expect about $50 million of premium freight as, supply bases come back online and we're working to get those parts and components into our facilities. So that would be the one of the bigger ones. On top of that, it's harder to quantify some of the, disruption or, to your point, social distancing, additional PPE to keep folks safe. So there are other costs, relative to operating in this environment, as well as just some of the inefficiencies relative to disruption. So we have some of those really in both divisions. But, if you think about, from an ag and turf perspective, we're talking about, for the full year decrementals in the, upper teens to low 20s. So feel really good about the ability to execute there in the uncertain environment.
Okay, great. And then you also, had mentioned, the replacement schedule and that some of, the sales this year were locked in from your early order programs. And we're thinking about next year. Can you just comment on, the willingness of farmers to replace their equipment given where commodity prices are today, and any impacts that, some of the government aid programs that we're seeing come through could impact those decisions?
Sure. That there's uncertainty created by what's happened with the pandemic. I think the big factors are thinking about what the demand will look like from the U.S.-China trade deal. It's certainly the case that our fleet is aging. So if you look at the availability to take technology and upgrade both the performance of the machine and the profitability of a farmer's operation, we really have two ways of doing that. We can take those technologies back across the existing fleet through performance upgrades, or we can trade those farmers going forward into new technology. I think the demand side of that is yet to be determined going into 2021 because there's a lot of interruptions. Certainly the government programs, if you look at what they've done, they've been a leveling effect that's helped customers both maintain their profitability throughout this year. Their insurance programs have given them a level. As we look to 2021, we'll look to the general economy and look to how trade continues through the remainder of the year.
All right. Thanks, Courtney. We'll go ahead and go to our next caller.
Thank you. Our next question comes from Rob Wertheimer with Melius Research. Your line is open.
Hey, good morning, everyone. So my question is on construction, and there's a pretty substantial dealer destock implied in the gap between your market and your own revenues. And my question is, did dealer inventory kind of trend the way you wanted over this cycle, or did rental fleets or something else get out of hand, as an output of that? Is it going to bounce back when the market comes back, or would you rather have a more streamlined dealer inventory? And then just a small one, how come you didn't cut construction a little bit more in 2Q versus 3Q, 4Q implied? Thanks.
Yeah, thanks, Rob. I think as you think about construction inventories, and really in particular, we're talking about North American construction equipment. We entered the year at 1Q. We talked about underproducing. We will underproduce, and we'll underproduce more than we expected to coming this quarter. I think the how much did it come down in 2Q versus expectations? The speed at which was candidly just faster than we would have expected, and we've taken actions there to pull back there, and as I mentioned, we'll underproduce and try to manage those accordingly. Maybe to the other part of your question, a little bit of the phenomenon, how we saw those inventories evolve. I think it's a combination of managing new fresh inventory in the dealer channel, as well as dealer-owned rental fleets. So, there's a combination. When we think about total dealer inventory, it's really two pieces in trying to manage the combination of those two. Now, one certainly, on the production side, as we underproduce, we can pull back the new faster, and the dealers will work through those, converting those rental machines into sales. So it's really a balance of managing both components. All right, thanks, Rob. We'll go ahead and jump to our next question.
Our next question comes from Steve Fisher with UBS. Your line is open.
Thanks. Good morning, guys. I just wanted to follow up on the margins and specifically in construction. Could you just talk about what you have assumed for the second half of the year? I think it implies around 1% margin. So are you assuming that you're profitable in both quarters or more profitable and losing money in the next? And then as you think beyond sort of 2020, how quickly could the margins come back there? And what does it really require? Is it sort of the neutralizing of oil and gas? Is it something more on the Wirtgen side, the synergies? Those are the questions. Thanks.
Yeah, thanks, Steve. I think when we think about the back half of the year for CNF, as mentioned, the biggest driver is volume and the underproduction that we're doing in the back half of the year. So that has a pretty significant impact. And I think when you think about road building for the full year, we expect to be down about 25%. So that's a pretty significant reduction as well on a business that drives pretty strong margin performance as well. I think as we look at overall, though, maybe pointed to your question, we'd expect that we're positive, in the back half of the year. So no major shifts.
But it's positive in both quarters, profitable in both quarters?
That's right.
Okay. Thanks very much.
Thanks, Steve. We'll go to the next question.
Our next question comes from Joe O'Dea with Vertical Research. Your line is open.
Hi, good morning, everyone. A question on the Ag and Turf margin guidance, with the midpoint calling for back half of the year revenue declines similar to what we saw in the first half of the year, but implying decremental margins in the mid 20% range versus low teens in the first half of the year. And so, what you're seeing to drive some of that difference in the decremental margin performance on similar revenue trends.
Yeah, I think when you think about back half, there's a few things. A couple that I mentioned, I think, in Courtney's question. But, so we do have some of these incremental COVID-related costs. So, premium freight, some of the inefficiencies just relative to disruption of the operations and another COVID-related cost. And then, FX, has turned, pretty negatively, as you saw, significant deterioration versus the dollar on a number of currencies, but in particular the Brazilian real. And obviously that was occurring in March, so you see more of that impact in the back half of the year. And then from a volume perspective, we do expect the back half to be down a little bit more than what we experienced in the first half of the year.
And specifically on mix, it looks like mix was a headwind in the quarter, but as we think about large ag that could be more stable relative to small ag, think about the aftermarket trends that you've been discussing, do you think about mix as being a tailwind in the back half of the year?
Yeah, full year we expect mix is favorable, and it's been relatively neutral kind of through the first half of the year, so that's correct.
Okay, thank you.
Thanks, Joe. We'll go ahead and go to our next question.
Our next question comes from Stephen Volkmann with Jefferies. Your line is open.
Hi, good morning, guys. Maybe just sort of a bigger picture or a longer-term question. I think some people I was speaking with were sort of surprised because, Corey, you laid out, a bunch of headwinds in the ag space relative to very large plantings and lower crop prices and demand questions and so forth. So I think it's a little surprising that your forecast isn't down a little bit more for the industry. So I guess I'm curious, are we just low enough that we're at an area where, we'll continue to see some replacement almost no matter what? Traditionally we haven't really viewed government funding as something, but maybe we're at a low enough area where that does happen now. I guess I'm just trying to figure out, how you're thinking about this from a little bit longer term perspective, as we get into, next year perhaps. Sorry for the long question.
No, I think you covered part of it in that we're at some pretty low levels overall, and we have a fleet that's sitting as old as it's been in probably a decade or a decade and a half, which means, one of the things that you see is the technologies available today give an opportunity for customers to lower their cost structure. In an environment where overall demand is the question, the thing that customers can do is invest to make sure they have the lowest cost of production of anyone in the market. So we see technology being driven across those acres. So old machine fleet, the ability to take products and technologies that we've delivered like ExactEmerge that's still relatively young in the market if you look at total acres planted, but will continue to grow, like our ExactApply and later our See and Spray technologies. We have the ability to change the cost structure on each acre. And if you take an aging fleet and you can change the cost structure, you have the ability to generate the sales. Their incomes have been buffered by the programs. The remain to be seen is overall demand for commodities and ultimately how trade works between the regions.
One other phenomenon that we've talked about is, our units, with replacement kind of getting pushed out with trade and then COVID, our units have been flattish and at a lower level, but we continue to grow the per unit sales in the business as customers continue to buy higher spec, more productive machines. And so that's a phenomenon that gives us a little more confidence that even if industry is maybe a little bit challenged, we're going to be able to outperform given our value proposition and given our customers' propensity to continue to upgrade and purchase our latest and most productive equipment.
Great. Thank you, guys.
Thank you. We'll go to our next question.
Yes, our next question comes from Tim Thein with Citigroup. Your line is open.
Thank you. Good morning. Maybe just to circle back, Corey, for you on your comments on the order board at Waterloo. I think you said into the fourth quarter. I think you're doing some movement or transitioning with the 8R with that line. So I'm just curious, you're taking that into account. Obviously, those slots can be impacted by production rates. So I'm just trying to, I guess, get a better understanding for what that actually means, in terms of where were you at this point last year, and is there any impact there in terms of potentially the actual build rates? Have they come down at all or been changed? So that's the question.
Yeah, thanks, Tim. Hey, this is Josh. I'll start. I think when you look at Waterloo, as Corey mentioned, 90% of the year ordered out. We've got, 8R's availability is into September, into kind of mid to late September. So we're continuing to move forward there. So I think that's a positive. Obviously now we're building the new machines as we go forward. We did see some disruption on the supply side. We spent a few weeks down as we were going through some supply challenges, and as a result, that's impacted a little bit of what we've been able to do in May. But as Corey mentioned, we're confident in the ability to catch up there and are back up running.
Yeah, the only other thing I would add is what that transition was taking place at the end of the second quarter. We're now building a product that's outstanding. From a customer perspective, as it's hitting the market, our customers have responded very favorably to it. So while we obviously have our current order book largely filled, we're very pleased with the performance of the new machine as it's hitting the market, and it contains a lot of game-changing technology as we move forward into 21 and beyond.
Got it. And Corey, just a reminder, how much output typically gets exported from Waterloo these days?
It varies year to year. So if you think about exports from Waterloo, though, it's predominantly would be Europe and some other parts of the world, like Oceania, Australia, New Zealand. But those would be some of the biggest ones, with Brazil now producing for themselves. So, thanks, Tim. We'll go ahead and go to our next question.
Our next question comes from David Raso.
Hi, good morning. To the year in ag and turf, that's the first half. I'm just trying to put that in better context. Can you help us with second half of last year? Your high horsepower, if I remember correctly, was underproducing retail. What will the production be in the back half of this year versus retail for ag and turf? Just so we get some section to, I'm assuming from these numbers, less underproduction. And then second, if you can help just quantify, where is it versus a year ago? Because when you say it's out through September, that just simply depends. It can be out a certain amount of months based off of whatever the line rate is. We're just trying to get a sense of that down 12.5%. How much is the swing from underproduction to less underproduction? And also some sense of the backlog, including maybe color on the new product, maybe helping that backlog more.
Yeah, I mean, I think as it relates to Waterloo, maybe starting in ag in total, the back half, we expect back half volumes to be down a little bit more than the first half, so not equally matched, so down a little bit in the back half. As it relates to Waterloo large or high horsepower row crop tractors, we're effectively for the year in terms of production relative to retail. Huge shift.
Second half? Just to be clear, I'm speaking just on the second half. Will production be in the second half of the year versus it's going against a year ago? Production versus retail, second half versus second half.
Basically, what's the year over year? And so a couple different factors that you have to think about. One is the industry. You point out correctly that we underproduced last year. So we underproduced last year, industry's down, so we're roughly in line. So production at some of our larger facilities is a little bit higher. As Josh talked about, our mix gets a little, that's offset by a really weak currency environment. So most of our currencies that we sell in outside the U.S. dollar have weakened significantly.
Okay, and the new product help to the backlog. And again, if you can just help us some way to quantify where is your backlog today versus a year.
Yeah, I mean, I think from where we've been a quarter ago, just because
from a year ago at the same time. I'm asking year over year. I apologize, I'm not being clear. The backlog today versus this time last year. I'm sorry, year over year.
Yeah, our orders in Waterloo are up about 10% year over year.
Okay, that's a lot easier on the guide then. Thank you so much. I really appreciate the time.
All right. We'll go ahead and do one more question.
Thank you. Our last question comes from Andy Casey, Wells Fargo Securities. Your line is open.
Thanks a lot, and good morning, everybody. Just a question on, how you would like us to look at the upcoming early order programs in Ag and Turf. I mean, outside of last year, order placement had been weighted to the early part of those programs, but with all the uncertainty you outlined in the market, should we expect farmers are going to continue to wait and see, and therefore, at channel checks and whatever, that the orders are probably going to be skewed towards the tail end when presumably visibility improves?
Yeah, it's a great question, Andy, and we'll kick off crop care EOPs here in early June. So I think, as you rightly note, lots of questions and plenty of uncertainty from a customer perspective. So I think we'll have to see how they play out.
Order programs will be a good indicator. Generally, is in the later parts of the phase anyway. So, it's our expectation is we won't know at the beginning of those early order programs. We usually have pretty good gates that we go through relative to the phases, as the last week of those phases generally give us a.
Thanks, Andy. Well, thanks, everyone. With that, we'll wrap up the call. We appreciate the interest, and
thank you for your participation. This does conclude today's conference call. You may disconnect at this time.